In previous session, what we have done is, in first lecture, we understood time value of money. Then we started with understanding security valuation and analysis. All the questions up till now were of security valuation. How to value the security? It is present value of future cash flows. This should be heading in your formula book. Yesterday I told you that you should be preparing a formula book. So this should be the heading of that book. To value anything in finance, you just need to find out the present value, and this should not be profits, and this should be cash flows. Yesterday we have solved some of the questions of having basic present value. Today also we'll be continuing with some of the questions of security analysis. This is C 1.2.3. Is it alright? This category of questions are based upon ratios. Again, it is divided into two parts, homework and classwork. We will be solving classwork and you will be solving homework on your own. So, these are the security valuation and analysis questions which are based upon some ratios. So, some knowledge of ratio analysis at intermediate level is required. We are directly starting first with third sum. From the following financial data are available for PQR Limited. For the year 2008, debentures are there, bonds are there. Equity share is there and reserves and surplus is there. Total asset is given. Asset turnover ratio is given. Effective interest rate is given. Effective tax rate is given. Operating margin is given. I'll explain you what is operating margin. Dividend payout ratio is given. Is it alright? Draw income statement for the year. Is it alright? So income statement for the year starts with sales or turnover. Is it alright? Which information will be useful for finding out turnover? It is total assets, which is 600. Asset turnover ratio, which is 1.1. Now in intermediate you have learned turnover ratios. How to find out turnover ratios? Try to understand. If the turnover is of total asset, the total asset will be in denominator. What is in numerator is sales. This will be nothing but the total asset turnover ratio. If it is working capital turnover ratio, working capital will be in denominator. If it is debtors turnover ratio, debtors will be in denominator. Is it correct? So what will be sales if the asset turnover ratio is 1.1? Sales we need to find out. Total assets is given as 600. So sales will be 600 into 1.1. It is 660. So we have got our first answer, which is nothing but 660 rupees. The rupees is in crores, in lakhs. That does not make any difference. Is it? Now, operating margin is 10%. What does it mean? Turnover's 10% is operating profit. What does this mean? Minus operating expenses, and I will be getting answer of operating profit. Is that alright? What is operating profit? 660 into 10% is nothing but 66. So what will be operating expenses? It will be 594. So if my calculation is somewhat correct, any student can just switch on the mic and just remind me that I am doing something incorrect. This will be operating profit. Operating profit is also termed as EBIT, is earning before interest and tax. Let us go to other information. I need to draw full income statement for the year. Effective interest rate is 8%. Now, which are interest bearing liability? Debentures and bond? Is it alright? What is the total debentures and bonds? 125 and 50. So total is 175. Is it alright? I think I can find out directly interest also. Why effective interest it is given, I don't know. Alright, this might be the market value. That is alright. Total is 175 multiplied by 8%. 175 multiplied by 8% is 14. So interest cost I have found out, which will be 14. Effective tax rate is 40%. This also I will be using. Operating margin I have already used. The dividend payout ratio is 16.67%. This also I will be using. Sorry. Let me go to interest. We all know, right? EBIT minus interest minus tax minus preference dividend and minus equity dividend. Sorry. So this is not preference. Yes. Minus interest, which I have calculated as 14. Alright, so what is this? It is earning before tax minus tax. What is the tax rate? 40%. So 52 into 40% is 20.8. So I will be getting answer of EAT, which is 52 minus 20.80. It is 31.2. So alright. Now, is this 31.2 earnings available to equity and preference shareholders? Yes, but there are no preference shares. Is it alright? So directly, what will be declared is equity dividend. Is it alright? Now, what is equity dividend payout ratio? Dividend payout ratio is 16.67. Dividend payout ratio, dividend ratio and dividend yield. This all three are different. Please try to understand. Dividend payout ratio, let me explain you all three. Yes. So what is dividend payout ratio, dividend yield ratio and dividend ratio? Try to understand. If someone tells me that dividend is paid at 10%, this is a dividend ratio and is on face value. 10% on face value will be declared. Dividend payout ratio is a 10%. What does this mean? This 10% is of earnings. So if the company is earning 100 rupees, it is paying out 10%. Dividend yield ratio, say is 10%, then this 10% is on market price of share. Is it alright? So yield is calculated on market price, dividend ratio is calculated on face value, and dividend payout ratio is calculated on earning. Is this earnings? Yes. Which ratio is given to me is dividend payout ratio? Is it alright? Dividend payout ratio is 16.67% of 31.2. It is 5.20. It is 26. This is earnings available to equity shareholders. So this is my profitability statement. So I have answered question number 1, that is draw income statement for the year. Calculate its sustainable growth rate. This we are discussing since last 3 lectures. Growth rate is nothing but a retention ratio multiplied by return on equity. Is it alright? How I'll calculate my growth rate? It is B into R. Your calculation of B is simple. What is the dividend payout ratio? 16.67. Is it alright? Then retention ratio is 1 minus 16 point, that is 100 minus 16.67. Is it right? 100 minus 16.67 gives 83.33. So what is the retention ratio is 83.33%. R is somewhat typical. Please try to concentrate. R is a return on investment or return on equity. Normally it should be taken from owner's point of view. So who are the owners of this company? Please try to understand. Owners of this company are equity shareholders. And please understand, reserves and surplus always becomes a part of equity. Is it correct? So who are the owners and how much is their investment? 400. Is it correct? So this is equity. It is also termed as equity. Is 400? What is the return on equity? Is it 26.0? No. Even this 5.2 is paid to equity shareholders. So what is the return to equity is 31.2. Is it alright? If I want to find out in percentage terms, I will be finding out R or ROE, return on equity. Earnings available to equity shareholders. This is earnings available to equity shareholders. Is it alright? This is net earnings 31.2. What is equity? Return on equity is return divided by equity multiplied by 100. But you need to take return of only equity shareholders divided by 400 as calculated here, multiplied by 100 is return on equity. What is return on equity? 31.2 divided by 400 multiplied by 100. It is 7.8%. Is it all right? So R is a 7.8%. How to calculate this? Please try to concentrate. It is 7.8% multiplied by 0.8333. It is a 6.49. 6.49% is nothing but my growth rate, which is nothing but a retention ratio multiplied by return on investment. Here I have taken return on equity. We can take any return on investment. Is it all right? So this is growth rate. That was question number 2. This was question number 1. Calculate the fair price of the company's shares using dividend discount model. All right. For required rate of return, first I'll need a dividend. Is dividend available? Yes, 5.2. But this is for whole of the company. 5.2 lakhs is for whole of the company. How many number of shares are there? I will be getting dividend per share. First, how I will be valuing it? Valuation of the share, I will be finding out value as on today by this formula, cash flow of first year divided by rate of return minus G. Cash flow of first year I can take earnings approach. I can take dividend approach. Here they have told me to take a dividend, so I am taking the dividend. But dividend, if I want to find out value of one share, I need to take value of the value of one share. Now what is the total dividend declared? Total dividend is 5.2 lakhs, that is 5,20,000. Divided by number of shares, I will be getting dividend per share. Number of share is 100 lakhs divided by 10 is nothing but 10 lakhs. This is 0.52. Is it all? I am assuming it is a D1. You can assume this as a D0. You can assume this as D1. It does not make any difference. Is it alright? So I am assuming this as D1. If the book has assumed it as D0, I don't know. Yes, they have assumed it as D0. Let me also assume it as D0. Because, sir, what if you have assumed it as D1? It does not make any difference. Is it alright? They should be telling me whether it is D0 or D1. If it is not written, you can assume anything. So I'm assuming it as D0. Is it all? I will have to find out D1. D1 is 0.52 plus that growth rate, 6.49. 0.52 multiplied by 0.0649 plus 0.52 is 0.553. Will be D1. That's it all. Return on investment I have not read anywhere. No, it is given. Required rate of return of investor is 15%. Not as per CAPM model, they have directly given me. Is it all? So I can find out this is 15%. So D1 I have found out, ROI is 15%. Growth rate is already what I have found out, 6.49. My answer will be 0.553 divided by 15 minus 6.49%. It is 0.553 divided by 15 minus 6.49 is 8.51%. This answer will be 0.553 divided by 0.0851 is a 6.49. Will be nothing but valuation of this particular share. Yes. Fourth question. What is your opinion on investment in the company at current price? What is your valuation of the share, or what is the intrinsic value of the share? Or what is the maximum price you are ready to pay for the share? Is 6.49 rupees. What is the market price of share? 14. What is my answer? This should be your answer. Always write down in technical manner. Market has overvalued. You should not purchase. If you are holding the share, sell it because you are getting higher prices. There is a solution of all four questions given. 1, 2, 3, 4. This was a C 1.2.3. Is it all? Now with this question there are formulas which are used. Is it all? Sir, where to learn this formula? In CA final it is assumed that you have done ratio analysis at your intermediate level and you know all the ratios of intermediate level. Please understand, this is one question where asset turnover is used. Sometimes they will use DSCR, sometimes they'll use interest coverage. So what is advisable is go to your intermediate books and learn out and understand all the ratios which are available over there. Is correct. This is C 1.2.3. We are going to next question, which is C 1.2.4, which is having some points of interest coverage ratio. Tiger Limited is presently working with an earning before interest and tax of rupees 90 lakhs. Its present borrowings are 12% term loan, 15% from bank and public deposit at the rate of 11%. So all these are debt. The sale of the company are growing, and to support this, the company proposes to obtain additional borrowings of rupees 100 lakhs, expected to cost 16%. The increase in EBIT is expected to be 15%. So EBIT will increase by 15%. Calculate the change in interest coverage ratio after the additional borrowing is affected. Is it alright? This is a question of interest coverage ratio. I'll tell you why it is in the chapter of security analysis. I am talking about before, and I will be finding out interest coverage ratio. What is interest coverage ratio? In denominator there is interest. In numerator there is your earnings. Why only EBIT is taken as EAT is not taken? It is very obvious. Interest is paid from EBIT. After deducting interest, you get answer of EAT. So the deduction should be made always from, or the comparison should always be made from EBIT. What is this? If EBIT to an interest is 1, this means your earnings are 2 times more as compared to interest. So your interest expense will be easily covered by your income. Is it alright? So this is interest coverage ratio. EBIT currently is given as 90. I need to find out interest. Interest will be 300 into 12% plus 200 into 15%. You can find out in separate working note also, but I am finding it out over here. And 100 into 11%. This will be my total interest. So it is 90 lakhs divided by, what is this is? 300 into 12% and plus 200 into 15% M plus and 100 into 11% M plus. MRC is 77 lakhs. Is it all? What will be interest coverage ratio is 90 divided by 77 is 1.16. Interest coverage ratio is in times. That's right. It is the original interest coverage ratio will be 1.16. That's right. After additional borrowings, interest coverage ratio will the formula will remain same. EBIT divided by interest, but EBIT is increasing by 15%, right? Yes, it is increasing by 15%. So EBIT will be 90 plus 15% divided by interest. What is existing interest? 77 lakhs. What is new interest? 100 lakhs into 16% is 16 lakhs more. What will be my answer? 90 into 0.15 plus 90 is 103.5 divided by 77 plus 16 is 93. And my interest coverage ratio will become 103.5 divided by 93 is 1.112. And this is a pure question of ratio analysis of intermediate level. Believe me, what is asked is interest coverage ratio. Now the point, why sir this is in security analysis? Try to understand, there is only one base of portfolio management that we are going to learn. You need to reduce your risk and increase your return. If you want to reduce your risk, you need to know how to measure the risk. Understand, higher the interest coverage ratio, lower is the risk. Lower the interest coverage ratio, higher is the risk. Higher the interest coverage ratio, lower is the risk. lower the interest coverage ratio, higher is the rest. Now your profit is less sufficient as compared to previous position to cover your interest. Is that right? And so it becomes a part of security analysis or portfolio management. So anything can be asked. As I told you, learn all the formulas of ratio analysis in your intermediate level. You will be very comfortable in this type of questions where some ratios are involved. Is that right? Next question is 1.2.2. One of my favorite question of valuation. Is it alright? It requires n numbers of analytical points, even knowledge of some different points. It was 6 marks question. 1.2.2. Calculate the value of the shares from the following information. Profit of the company is 290 crore. Equity capital of the company is 1300 crore. Par value of the share is, face value of the share is rupees 40 each. Let me find out number of shares even. Is it alright? It will be 1300 divided by 40. It is 32.5 crores. Debt ratio of the company is 27%. Again, this is based upon ratio. Debt ratio means if the total borrowings are 100, debt is 27%. Is it alright? Long run growth rate of the company, this is G. Beta is 0.1. Risk free rate of interest is 8.7. Market rate of return is 10.3. With these two informations, as per CAPM model, we have already done. Required rate of return will be RF 8.7 plus beta 0.1 into RM minus RF, that is a 10.3 minus 8.7. Let me find it out. 10.3 minus 8.7 multiplied by 0.1 plus 8.7 is nothing but 8.86. So instead of directly given required rate of return of 8.86%, they have given these two informations. Capital expenditure per share is 47. This will be important. I'll teach you what to do with it. Depreciation per share is given and changes in working capital is given per share. What we need to find out? Calculate value per share. Is it alright? Alright. Can I find out value per share by this formula? Cash flow of first year divided by rate of return minus G. Yes, I can do it. Everything is available except this. Is it alright? Cash flow of first year is not available. Rate of return I have found out 8.86%. Growth rate is directly given, which is nothing but 8%. Is it alright? So I need to find out cash flow of first year. Now understand. First, let me understand the operating profit is operating cash flow. But what is the profit? It is given. Profit of the company is 290 crore. So let me find out operating profit. And I will be assuming it is cash. So what is the profit of the company? 290 crore. Divided by number of shares is 32.5 crore. This will be earning per share. It is 290 divided by 32.5. It is 8.92 crore. Crore is getting cancelled, so it is just 8.923 per share. It is EPS. Is it alright? Please try to understand. Now I am trying to find out the cash flow. For finding out cash flows, my earning is 8.923 rupees per share. But this considers only the operating expenses. It does not consider the capital expenditure, which I need to take into consideration. So, my income or cash flow will be reduced by some capital expenditure. What is capital expenditure per share is 47. But out of which 39 is depreciation. Depreciation is non-cash. So this will be 8. So from somewhere you'll have to take out your 8 rupees. This will be cash outflow for owners. All of you agree? This will be cash inflow for owners. This will be cash outflow for owners. Sir, but it is capital expenditure. Please understand, revenue and capital is a concept of accountancy. In finance, what is calculated is cash flow. Whether you pay 5 rupees for salary or whether you pay 5 rupees for fixed asset, it is cash outflow in finance. So you need to consider capital expenditure. Is it alright? So 8 is my capital expenditure, which will be my outflow. I've already subtracted. So there is also another outflow, which is a change in working capital, and I'm assuming it is increase in working capital. So they should always write down it is increase in working capital. Now what is increase in working capital? Try to understand. Say you are having a bookstore. For working capital, bookstore is a best example. I am having books worth rupees 10 lakhs in my showroom. In my bookstore, I am having books worth rupees 10 lakhs. When this 10 lakhs will be recovered back, believe me, working capital is recovered when you close your business. So practically you are never planning to close your business and it will never be recovered. Sir, when it gets sell, it is not recovered. No, then you will again have to have a stock. Assume a bookstore which is empty, which is having no stock. There cannot be a business without of bookstore without a stock. Is it alright? So they will have to keep this stock or money invested in working capital. And what was money invested? 10 lakhs. Is it alright? Now, you have increased your space and now you require the stock of 12 lakhs. Then this 2 lakhs you will have to take out from your pocket. When it is going to be recovered? When your business is closed, or it will never be recovered. Is it alright? But this 2 lakhs right now you need to take out from your pocket. So increase in working capital is also your cash outflow. And what is increase in working capital is 3.45. Is it alright? So this both is your cash outflow. Is it alright? Most important point, try to concentrate over here. What is the total answer? 11.45 will be my additional cash outflow. But please try to understand, the company is having a policy that they always take outside money of 27%. Whatever is required, 73%. Yes, 73% is financed by equity and 27% is financed by debt. So what does this mean? Owner will not have to take out from his pocket this whole amount. He will have to take out only 0.73. That is only 73% of money. Where remaining 27% of money will come from of this? Will come from debt. They will borrow the money from the bank. Sir, interest is payable on that money? The answer is yes. Is it alright? So they will not be, this will not be owner's money. This will be outsider's money, 27%. And so owner's money going out will be 0.73. Please understand, you need to calculate cash outflow only of owners, because you are valuing equity shares, and whenever you are valuing equity shares, only equity shares owner should be treated as owner of the company. Is it all? This will be my cash flow. Is it all right? So the answer will be 0.73. This is into 11.45 minus 8.923. It is, sorry, that's a mistake, 11.45 multiplied by 0.73, it is 8.3585 minus 8.923. It is 0.5645. Will be nothing but cash flow of first year. Sir, can't it be considered as a cash flow of first year? The answer is yes. You can consider it as cash flow of first year. You can consider it as cash flow of 0 year. So I am considering this as a cash flow of 0 year. See, I am taking the same assumption as per book. If the assumption you are taking this as a C1 or cash flow of first year, it does not make any difference. You get 100% of marks. So this is cash flow of 0 year. Cash flow of first year will be plus 8%. It is 0.5645 plus 8%. 0.5645 is 0.6096, and this is the place where the full question run around. It is 0.6096 divided by, let me write down properly, this is 0.86 percentage. So this will be 0.6096 divided by 0.0086. It is 70.88. Is nothing but my answer of value of share of this particular company. Is it alright? This is again based upon ratio because here debt ratio was given. Is it all? What is debt ratio? Debt divided by debt plus equity. So it is debt plus equity or total capital. Debt divided by total capital is nothing but a debt ratio. Is it all? This is a good sum because this portion is excellent in this particular sum. This was question number C 1.2.2. Let us go to next sum, which is C 1.2.1. This was C 1.2.2, sorry. This is 1.2.1. Capital structure of Sun Limited as at 31st March 2003 was as under. Now this is capital structure of the company. Equity share capital is 80 lakhs. 8% preference share capital is 40 lakhs. 12% debenture is 64 lakhs and reserve is also 32 lakhs. Sun Limited earns a profit of rupees 32 lakhs annually on an average before deduction of income tax, which works out to be 35% and interest on debentures. So practically it is EBIT. This is nothing but EBIT. Normal return on equity shares of the company's similar place is 9.6%. So what is your required rate of return? 9.6%, provided profit after tax covers a fixed interest and fixed dividend at least 3 times. Capital gearing ratio is 0.75. Yield on share is calculated at 50% of profit distributed and 5% of the profit undistributed. Sun Limited has been regularly paying equity dividend of 8%. Compute the value per equity share of the company. Again, I need to find out equity share value of the company. Is it all? I can easily find out earnings from this. This is required rate of return. Growth rate is not given. Is it alright? Growth rate is given or not given? It is not given. I can find out growth rate, which I'll be finding it out. Is it alright? Let me first start with EBIT. Is 32 lakhs minus interest. Interest will be 12% of 64 lakhs. It is 7.68. This will be earning before tax. $24.32 minus tax is 35%. I can easily get earning after tax. It is 24.32 into 65%. It is 15.808. Will the preference dividend be paid from it? Yes. 15.808. Preference dividend is %8 of 40. It is 3.2. This is 12.608. Will be earnings available to equity shareholders minus equity dividend. Regularly paying equity dividend of 8%. Is it dividend payout ratio? No. It is dividend ratio. So on face value 80 lakhs, it is paying 8%. That is 6.4. And your profit will be 6.208. Is it alright? So this is nothing but our income statement. Which formula I will be using for solving this particular question is value of share will be is equal to my earnings divided by rate of interest. Is it alright? So it is a present value of infinite cash flow without growth. Present value of infinite cash flow without growth. Is it alright? Why not with growth? I'll explain you. But first let me find out all the points. Is it alright? First I need to find out this earnings. Is it alright? Now I can take dividend. I can take earnings per share. But in this question, I will be taking this. That's alright. I am finding out yield on share is calculated at 50% of profit distributed. So what is distributed profit? 6.4 lakhs. Is it alright? So 6,40,000 into 50%. And 5% on undistributed profit. So what is undistributed profit? Is a 6.208, that is 6,20,800 rupees. 5% of this. It works out to be 6,40,000 into 50% and plus 6,20,800 into 5% and plus MRC is 3,51,040. Will be my yield. Is it alright? And this figure I will be taking for the purpose of cash flow or for valuing the company. Is it alright? 50% of distributed profit and 5% of undistributed profit. So when we write down cash flow of first year, which were the two ideas in our mind? I can take dividend, I can take earnings. Here comes the third idea. The question might tell you what to take as a cash flow for the purpose. Is it alright? Now, this is total yield. I need to find out the per share and understand in this question value of the share or face value of the share is not given. Directly what is given? Equity share capital. I am assuming face value of 100. So number of shares will be 80 lakhs divided by 100 which is nothing but 80,000. So 80,000 will be number of shares and yield per share will be 3,51,040 rupees divided by 80,000. 3,51,040 rupees divided by 80,000 is a 4.388 will be cash flow per share. Is it right? 4.388. I can write it in numerator. Let me go to denominator. Believe me, this answer will be different from suggested, but still it is absolutely correct answer. For finding out required rate of return, I will be using this information which is provided. See what does the question says. Normal return on equity shares of the similar type of company placed as 9.6%. So what should be your required rate of return? Should be 9.6%. Provided, number one, profit after tax covers fixed interest and fixed dividend at least 3 times. Sorry. Profit after tax covers. Now what is profit after tax? See, many of the people will say this. Is it alright? But understand, whenever you are trying to cover interest, you should always take this figure. Is it alright? So practically it will be EBIT minus tax, because tax is outside expense. Or you can do earning after tax plus interest. So what is deducted in EBIT is only real tax. Is it alright? So it is, I am going on the side 15.808 plus 7.68. 15.808 plus 7.68 will be my earnings for this specific purpose. It is a profit after tax or relevant profit after tax. $15.806 plus 7.60, it is 23.486 is my relevant profit for this purpose. Should cover, what it should cover? Fixed interest is 7.68 and fixed dividend is 3.2. So total will be 7.68 plus 3.2, which is nothing but 10.98. Is it alright? So this is my expense, this is my profit, and they say that my profit should be covering this particular expenditure 3 times. Let me find out in this case how many times it is covering. 23.486 divided by 10.98. 23.486 divided by 10.98 is 2.13. What is industry criteria? Is 3. Are you matching with industry criteria? The answer is no. Let us go to second point first. Capital gearing ratio should be 0.75. What is capital gearing ratio? Please try to understand. Again, you should be knowing the formula from your low standard. Capital gearing ratio, in numerator you write down fixed interest bearing security, and in denominator you write down equity, not equity share capital, but equity plus reserves. Is it alright? So let me find it out. Fixed interest, it includes the preference dividend also. Is it alright? So it is, sorry, I'm making not it is fixed interest, it is fixed interest bearing security. Fixed interest bearing security. So this will be preference dividend, preference shares plus debentures, and on denominator it will be equity plus reserves. Let me find out of this company which are fixed interest bearing security. This two, 40 plus 64 is 104 lakhs. So in numerator I will be writing down 104 lakhs divided by denominator is equity plus reserves. Equity plus reserves will be 112, right? Yes, 112 lakhs. What will be the ratio? 104 divided by 112 is 0.92. What does this ratio shows? How much is your debt or how much is your fixed interest bearing security as compared to your non-fixed bearing security, fixed interest bearing security. Is it all? It is 0.92%. So if there is one equity, there is 0.92 fixed interest bearing security. Is it all? What is industry criteria? Industry criteria is 0.75 and you are having 0.92. Let me explain you once again. The required rate of return of similar company is 9.6%. So for your company also it should be 9.6%. But if your company is similarly risky as compared to industry, whether it is not. Because in industry, the interest coverage ratio or interest and preference dividend coverage ratio is 3, yours is 2.13. So yours is greater risky or higher risky as compared to other companies in the industry. So 2.13 and 3, I will be adding 1% because my company is more risky. Sir, why not 0.5%? You can add 0.5% also. But you should not deduct. As the risk increases, the required rate of return increases. Understand that CAPM model. Risk increases, your required rate of return increases. Is it alright? So this will be, and again, what is the industry criteria for capital gearing ratio is 0.75. What does 0.75 industry criteria means? When in industry other companies is having one equity, they are having 0.75 debt plus preference. Your company, when there is 1 rupee equity, it is having 0.92 debt. And understand, you might have learned this. Debentures are more risky as compared to equity shareholders because it carries fixed rate of interest. Equity share is floating rate of interest. Is it alright? So this is more risky. Our company is more risky, and so I am adding 1% for that also. See what is done in suggested. They have even compared how much percentage should be increased. Believe me, which is not required. I am adding 1% approximately for this risk premium and 1% for this risk premium. Can you add 0.5, 0.5? Yes. Can you add 0.2, 0.2? Yes. Can you deduct? The answer is no. You need to understand that higher this ratio, your company is more risky. Lower this ratio, your company is more risky. And as your risk increases, your required rate of return increases. There's 9, 10. 11.6%. As I told you, our answer will not be matching with the book because these figures will differ. 11.6% is my required rate of return. 4.388 divided by 11.6. $37.82 rupees. Believe me, if you take same figures as given in the question, your answer will match even with suggested answer. Please understand, in CA final, your answer should match with your valid assumption. Once you are following that valid assumption, your answer will be fully correct and you will be given 100% of the marks. Don't understand that in this at this level, as the answer is not matching, you will be getting 0 marks. Your calculation is important, your logic is important, your assumption is important, and the checking will be done based upon that. Is it all right? This is question number C 1.2.1. The question in this is, before you ask me, I am asking you one question. Why cannot we take that G factor? First, can we find out G? Can we find out growth rate? Any student? Meg?
Yes, sir. Thinking.
There is only one formula to find out G. It is B into R. Can we find out retention ratio? Yes. Why? From this two figure, I can find out dividend payout ratio. And 100 minus dividend payout ratio is retention ratio. So I can find out B. What is our return on equity? Can I find out return on equity? Yes. This is my equity. This is my return. This is my equity. I can even find out return on equity. Is it alright? And I can find out growth rate in this. Is it alright? But here, please understand, I am not saying it is absolutely correct. But here the growth rate is not considered because of this. Because they are telling us that whatever is 50% of distributed and 5% of undistributed profit is assumed to be my cash flow for infinite period of time without growth. I am not saying this assumption is absolutely correct, but this is the reason they have not taken G. Is it wrong? Otherwise, G can be found out, it can be used also, and you can easily find out value of the share based upon G. Is it wrong? So this was question of C 1.2.1, and we have covered all the questions which are based upon ratios. Yes, we are going to next point, that is a preference shareholder conversion type of questions. Alright. Now, in this two questions, we will be learning something about convertible preference shares. First, let me explain you what is the meaning of convertible preference shares. Convertible preference shares are the preference shares which can be converted into equity shares today, at a specified date, or on maturity. Is it alright? So this shares which can be converted into equity shares are known as convertible preference shares. There are other points also which is to be learned in this conversion, and we will be learning all the points one by one. Let us first understand this. XYZ company has a current earnings of rupees 3 per share with a 5 lakh shares outstanding. So total earning will be 15 lakhs. The company plans to issue 40,000 7% convertible preference shares of rupees 50 each at par. So what is the face value is 50. The preference shares are convertible into 2 shares for each preference shares held. So if you are having one preference share, you will be getting 2 equity share if you opt for conversion. The equity share has a current price of 21 per share. Is it alright? What is the preference shares conversion value? We are first learning, first concept in this is a preference shares conversion value. Before giving you the formula, please try to understand what does this mean. If you are holding one preference shares, if you convert it into equity shares today, what will be value of that total equity shares? If you are having one preference shares, if you are converting it into equity shares today, how many equity shares you will be having? 2. multiplied by what will be the value of one equity share is 21. So what will be value of two equity shares which is equal to one preference shares is 42 rupees, and this is nothing but conversion value of preference shares. If you are converting your one preference shares today, you will be getting equity shares worth rupees 42. That's it all. It is as simple as this. What is conversion premium? Is it all right? What is conversion premium? Is it all right? Please concentrate, the premium is negative, but let me first find out conversion premium. What is the current market price of the preference shares? 50? That's correct. So premium is a 50. If it is converted into equity shares, what is the value? 42. You cannot take 21 because one preference shares is equal to two equity shares. So what is a premium is 8. Is it alright? What does this mean? Try to understand. You are having premium of rupees 8 not to convert your preference shares into equity shares. You are having a benefit of rupees 8 not to convert your preference shares into equity shares. This is premium. Premium should always be calculated on percentage terms. So it is 8 divided by 50 into 100. Surprisingly, the conversion premium is calculated on 42 and not 50. Please understand, it should be calculated on 50. But in this is a tradition of finance that it is calculated on the conversion value. The premium is calculated on conversion value and not on the market price of the preference shares. So I will be doing 8 divided by 42 into 100. Is it correct? It is 8 divided by 42 into 100, which is 19.04%. Is it alright? See, what does this mean? If the share price increases by 19.04%, then I will be having an incentive to convert my preference shares into equity shares. If my share price increases by 19.04% or more than 9, see if the share price increases by 20%, believe me, I should convert my preference shares into equity shares because now I will be getting that benefit. This is conversion premium. Let us understand question number 3. Assume that the total earnings remains the same. Calculate the effect on issue on the basic earning per share before conversion and after conversion. So assume that total earnings is remaining same. Total earning is 15 lakhs. Earning per share is 3 and number of shares is 5 lakhs. So it is 15 lakhs. Earnings is 15 lakhs rupees. What will be number of shares if this preference shares are not converted into equity shares? Number of shares will be 5 lakhs. Basic EPS is 15 lakh divided by 5 lakh is nothing but 3 rupees per share. Now, if you have learned accounting standard, there is a concept of diluted EPS. What is a diluted EPS is if this preference shares are converted into equity shares. Now, how many preference shares are issued? 40,000. Each preference shares will be converted into 2 shares. So total 80,000 shares will increase. What is the original shares? 5 lakhs. plus how many number of shares will increase is 80,000. Is it alright? What I should be taking as alright, yes, this is incorrect because this is earnings. Yes. So I have assumed that they have deducted the preference shares, but preference dividend is yet to be deducted. And what will be preference dividend? Preference dividend will be 40,000 into 50 is par value. 40,000 into 50 is par value multiplied by 7%. It is 1,40,000 is nothing but preference dividend which should be deducted. That's correct. So preference dividend is 1,40,000 and earnings available to equity shareholders will be 13,60,000. So I need to correct this. Basic EPS will be 13,60,000 divided by number of share is 5 lakhs, which is nothing but 13,60,000 divided by 5 lakhs is 2.72 rupees per share. What is diluted EPS? As I told you, if this shares are converted into this preference shares are converted into equity shares, then what will be the EPS is known as diluted EPS. Then number of shares, as I told you, will be 5,80,000, but now this preference dividend will not be paid. So what will be your earnings is 15 lakhs. Sorry. So it will be 15 lakhs divided by 5,80,000. 15 lakhs divided by 5,80,000. It is 2.586. So if all the preference shareholders convert their shares into equity shares, they will be getting EPS of this. If all the preference shareholders does not convert into equity shares, the EPS of the company will remain 2.72. This is basic and diluted EPS. Alright, fourth one. If profit after tax increases by 1 million, 1 million is 10 lakhs. What will be the basic EPS before conversion and on fully diluted basis? They are just telling that profit after tax increases by 10 lakhs. So if you just need to find out an alternate answer, if earnings are 25 lakhs minus preference dividend 1,40,000, this is going to remain same. This will be 23,60,000. N is going to remain same as 5 lakhs. Basic EPS is 23,60,000 divided by 5 lakhs. 23,60,000 divided by 5 lakhs is 4.72. And diluted EPS will be 25 lakhs because now preference dividend will not be paid, divided by 5,80,000. It is 25 divided by 5.8. It is 4.31. So they have just asked an alternate answer in this particular question. Basic and diluted EPS question is covered, and preference share conversion value and conversion premium. Those are the 2 points that is covered in this particular case. Is it alright? In next sum, we will be covering 2 more concepts. It is instead of preference shares, it is bond, but still it is a same type of question. The data given below relates to the convertible bond. Face value is 250. Coupon rate is 12%. Number of share per bond is 20. Market price of the share is 12. Straight value of the bond, I will be telling you what is the difference between this. Straight value of the bond and market price of the convertible bond. Find out stock or share value of the bond. Is it alright? Stock is share. Is it alright? So answer number 1, share value of bond. If the bond is immediately converted into shares, how many shares I am getting? 20. What will be the value of each share is 12. It is 240 rupees. It is the same as we have calculated in previous question. The percentage of downside risk, this I will be telling you afterwards. Let us first solve this third question. The conversion premium. What is the market price of the bond? Forget about 235 right now. It is 265. What is the conversion value? 240. What is the premium? 265 minus 240. Percentage conversion premium. Is it alright? What is the premium? 265 minus 240 divided by it is always calculated on conversion value. Percentage is always calculated on conversion value. Is it alright? This will be 25 divided by 240 multiplied by 100. 10.41. Those who want to understand logically, try to understand what does this mean. Keeping this price as constant, bond value as constant, if the market price today increases by more than 10.41%, I will be going for conversion. Right now I am not going for conversion. But if the share price increases by 10.41%, I'll be going for conversion. These two are the points that we have learned in previous question also. Third and fourth is different. Let me first solve fourth. The conversion parity price of the stock. What is the share value of the bond? 240. Is it all? No. I need to find out conversion parity price of the stock. Is it alright? See, what does this mean? First, let me find out. What is the price of the bond? 265. Is it all? This is market price of bond. Is it all? Divided by how many shares you are getting per bond? 20. Is it alright? 265 divided by 20. It is 13.25. Please concentrate. If the market price of the share today is about 13.25 rupees, then I will be going for conversion. Otherwise, I will not be going for conversion. Try to understand. This timeline is for market price of share. This is 13.25 rupees. In this place, I will convert my bond into shares. At this place, I will not convert. And this price is, it is not termed as equilibrium, but indifferent. So what does this mean? If the market price is exactly 13.25 of share, you are indifferent in converting or not converting. Whether you convert or whether you don't convert, you will not make any difference as far as your holding value is concerned. This type of price is known as conversion parity price of the stock. Is it alright? This is 13.25. 5 rupees. Is it alright? Last but not least is a percentage of downside risk. Please try to understand. You are already having a bond, and all of you know that bond never becomes worthless. Why? Because it carries a fixed rate of interest. Is it alright? If these bonds were not convertible, then the market price of the bond would have 235, face value of the bond would have 235, everything of the bond would have 235. Is it alright? The issue price would have been 235. Even if the face value is 250, it would have been issued at discount of 15 rupees and the market price would have been 235. Is it alright? So, this is a straight value of bond if it were not convertible. Is it alright? Now if they are convertible, understand, convertible bonds are a good security as compared to non-convertible bonds, because this bond can be converted into equity shares at any point of time. So you are having one more facility in this type of bond. So their market price is higher. It is 265. Is it alright? So I will be calculating this. Answer number 3. Sorry, it is not 4. It is answer number 3. What is the price of convertible bonds? 265 minus what is the price of non-convertible bond? 235. So the market price of the bond can be reduced maximum by 30 rupees. Maximum by 30 rupees. As weird as this, it is not compared with 265, it is compared with 235. Is it correct? Divided by 235 multiplied by 100. Percentage of downside risk. It is 30 divided by 235 multiplied by 100 is 12.77%. Is it alright? Please understand, 12.77% is the gap between non-convertible bond and convertible bond market price. Is it alright? If this bond were non-convertible, the price of this bond would have 235. As this bond is convertible, the price of bond has increased at 12.77%, and so this is named as percentage downside risk. Is it right? I absolutely agree that here there should be 265, but as I told you, conversion premium percentage on downside risk is always calculated on base lower side amount and not that higher side amount. So this is a percentage downside risk. Is it all right? This is all 4 points which is to be considered. Let us recapitulate and convert this all questions into formula. These are sometimes asked in examination. Share value or stock value of bond. Number of shares availed per preference share or bond multiplied by market price of share will be share value of the bond. Is it all right? Second was conversion premium. Will be is equal to market price of preference shares. Market price of preference shares. I am assuming preference shares. If it is bond, it will be market price of bond minus conversion value, which was calculated above, divided by conversion value multiplied by 100 will be answer of conversion premium in percentage. Third was conversion parity price of the stock. Conversion parity price of stock. Market price of preference shares. If it is bond, it will be market price of bond divided by number of shares. This should be the price at which you are indifferent of conversion and non-conversion. Last is percentage of downside risk. It is price of convertible debentures minus a price of non-convertible debentures if the debentures were not convertible. Divided by price of non-convertible debentures multiplied by 100. Price of non-convertible debentures is also, or non-convertible bond or non-convertible preference shares. I have written here debentures. As we are doing preference shares, I need to write down preference shares. It can be preference shares, it can be debentures, it can be bonds. But as far as I am writing all formulas, I have written preference shares, so I am writing preference shares. It can be debentures, yes. It can be bonds, yes. Is it all? Now, what is price of non-convertible bonds is also termed as straight value of bond. What does it mean? If these bonds were not convertible, what would be the price of this bond? Is it all? So, these three formulas is to be learned when you are doing this type of questions of preference shares of preference shares conversions or bond conversions. These are exhaustive formulas which can be asked in examination. I hope you will understand the formula logically rather than just mug it up. First, understand logically. Always put it into your formula bank. You should prepare a book which is having all the formulas. Put into it, and on the day before examination you can always read this type of formula so that you are very comfortable with this. See, many of the times this formula are also available online, but that will not be useful because this formula should be written on your own. Then only you will understand some of the jargons. Is it alright? Cash flow of first year. There it might be written value 1. Is it alright? You might not understand it. So you should always prepare on your own all the formulas which are covered. Is it alright? This is nothing but which category of sums are preference shareholders conversion sum. Is it alright? And now the questions that we are solving are of buyback. Is it alright? So let us go to that particular point of buyback. ABB Limited has a surplus cash balance of 180 lakhs and wants to distribute 50% of it to equity shareholders. So 80 lakhs, 50% is 90 lakhs. And they want to distribute. What does surplus cash means? They are having this cash as an excess cash. Now if they keep it with company, there is no use, but they will have to pay dividend on it. So they are planning to refund it either in form of dividend or in the form of buyback. I hope all of you are comfortable with the concept of buyback. What is buyback of the share is, the shares are floated in the market. Now what company will do is repurchase that share from the market. So suppose I am a shareholder of Reliance. Reliance will purchase shares from me, pay me my money back. Normally it will be greater than market price. Then only I will be ready to sell it to Reliance and not into the market. Is it alright? What Reliance will do with this purchase share? They will cancel it down. So their equity capital will reduce. Is it alright? This is nothing but buyback of shares. The company decides to buy back equity shares. The company estimates that its equity shares price after repurchase is likely to be 15% above the buyback price. If the buyback route is taken. Is it? Please understand. If your buyback price is X, it is not given. but then market price of share after buyback will be 1.15x, which is 15% more as compared to 1x. Is it alright? So this will be market price of the share after buyback. This is what is written. Estimate that the company decide to buy back. The company estimates that its equity share price and repurchase price is likely to be 15% above the buyback price if the buyback route is taken. Alright. Other information is as under. Number of equity shares outstanding at present is 20 lakhs. Current earning per share is rupees 5. Is it alright? Total earning also I can easily find out. You are required to calculate the following. The price at which the equity shares can be repurchased if the market capitalization of the company should be 400 lakhs after buyback. That's it, alright. Market capitalization, you might have heard this in stock market also. Market cap. Market cap is nothing but market capitalization. What is market capitalization is very easy. Number of shares multiplied by market price of share. Is it alright? This is nothing but market capitalization. See, a worth of the company is found out by market capitalization. Suppose a company is having 1 lakh shares with a share having market price of 10 rupees, then the company's value of all equity is nothing but company's value is nothing but market capitalization, which in our case will be 10 lakhs. In this case, the price at which the equity shares can be repurchased if the market capitalization of the company should be 400 lakhs after buyback. So this is market cap. Is it alright? Should be 400. Will be is equal to. Now, what will be market price of the share? This is market cap, right? What will be market price of the share will be 1.15x. What will be number of shares? Let me write down. N multiplied by market price per share will be nothing but market capitalization. What will be market price per share after capitalization is 1.15x after buyback. This is the market price of the share. What will be N? This is difficult. What are right now number of shares? Number of shares is 20 lakhs. Yes. It will not remain 20 lakhs. Try to understand. Why? Some shares will be bought back. How many shares will be bought back then? How many money you are going to use to buy back your shares? Is 90 lakhs. So, it will be 90 lakhs. Still I am not having the space. 90 lakhs. Money will be used divided by X. What is X? Buyback price, right? X is nothing but buyback price. Is it alright? So, 90 lakhs divided by X, this will be number of shares bought back. This will be number of shares which are bought back. Is it alright? So, original number of shares minus number of shares bought back will be remaining number of shares multiplied by market price per share is 1.15x. And the market capitalization should be 400 lakhs. This is what is given. Is it? Now, in any equation, if there is only one variable, it can be easily found out. I am not finding out this variable, directly taking it from book. which is nothing but X is equal to 21.89. And believe me, X is nothing but buyback price that we have assumed. It is not 1.15x. 1.15x will be our new market price. Is it all right? So X is 21.89. Is it all right? Number 2. Number of equity shares that can be repurchased. Is it all right? Number of equity shares that can be repurchased is this 90 lakhs divided by X, but now X answer I know, 21.89. It is 90 lakhs divided by 21.89 is 4,11,146. Number of shares can be bought back at this price. Let us go to question number 3. The impact of equity shares repurchase on EPS, assuming that the net income remains unchanged. Let me find out. EPS before buyback and EPS after buyback. EPS is nothing but earnings, total earnings divided by number of shares. Total earnings is current EPS is 5, number of shares is 20. 20 lakhs multiplied by 5 is 100 lakhs. So earnings is going to remain 100 lakhs. Number of shares before buyback was 20 lakhs. EPS will be 100 lakh divided by 20 lakh, which is nothing but 5 rupees per share. Is nothing but earning per share before buyback. After buyback, earnings is going to remain same. 100 lakhs. Number of shares will not remain 20 lakhs. Now it will be reduced because of buyback. It will become 20 lakhs minus number of shares bought back 4,11,146, which will be 20 lakhs minus 4,11,146 is 15,88,000. It was 15,88,000. Let me do it again. 20 lakhs minus 4,11,146 is 15,88,854. Number of shares, and EPS after buyback will be 100 lakhs as earning divided by 15.88854 lakhs. It is 100 divided by 15.88854, which is nothing but 6.29. EPS will of course increase because number of shares are decreasing and earning is remaining same. So it is obvious if denominator is decreasing, the number will increase. So this will be per share EPS after buyback. And this is what is asked. If even if it is not asked, we can find out there will be increase in 1.29 rupees per share as EPS. I don't know whether it is asked or not. Assume that the net income, the impact of EPS, yes, impact of equity share repurchase on EPS, you need to find out the difference even. Is it all? So both the answer should be written. Is it all? This is buyback of the shares, whether it is feasible, not feasible, how many number of shares can be bought back, is also nothing but security. It is not valuation. Yes, this is valuation, understand. What should be the price of buyback if your market capitalization is going to remain 40 lakhs? So this type of question is in chapter of security valuation as well as analysis. Is it all right? Ultimately, any analysis of shares can be covered in this particular chapter.